Welcome to the Deep Dive, your express lane, to truly understanding the forces shaping the financial world.
And today we're doing just that, TalkTickers style.
We're pulling back the curtain on BlackRock's latest earnings call, dissecting their Q2 FY25 results from July 15th.
Yeah, we'll unpack what really drove their performance, where management's focus lies.
And crucially, why the market reacted the way it did. We want to hand you the key insights without all the usual noise.
And this quarter from BlackRock, the world's biggest asset manager, it definitely gave us a nuanced picture. Pretty intriguing, actually.
All right, let's jump straight in. High-level snapshot first. Q2 FY25 revenue came in at $5.42 billion.
Right, and that was just a hair under expectations. So a slight miss on the top line.
But, and this is the interesting part, their adjusted earnings per share, EPS, hit $12.05.
Which significantly beat the consensus estimates. Really strong execution on the bottom line there.
It really suggests they're getting quite efficient, doesn't it? Converting revenue to profit.
Absolutely. It's not just market luck. It signals good operational control. And digging in, assets under management, AUM, well, they had a new record.
$12.5 trillion. Huge number, driven mostly by, $68 billion in net inflows?
That's right, $68 billion. But there's a big but here, isn't there?
Yeah, that single client redemption, you have to factor that in. It was a $52 billion institutional index outflow. Low fee, but still a big number.
Exactly. So if you pull that one specific event out,
the underlying inflows were much healthier. $116 billion, actually.
And that $52 billion redemption, that's really the key nuance, like you said. It changes the whole feel of the results.
So despite the slight revenue miss, the core story is really a strong bottom line beat, robust client interest underneath. That's a bit complex for investors.
A mixed bag, perhaps, but leaning positive on execution.
Okay, let's peel back those layers then. Take a proper deep dive. The year-over-year numbers look solid on the surface.
Yeah, revenue up 13%, operating income up 12%, and that EPS figure up a strong 16%.
Beyond those headlines, what's really powering this, especially in their core business?
Well, look at the organic base fee growth. That's key. They hit 6% in Q2.
And that's the fourth quarter in a row at 5% or more.
Exactly. And over the last 12 months, it's 7%. That consistent organic growth, it's like the engine room, shows they're pulling in new money, not just riding the market waves.
So how does that break down in the revenue mix?
Base fees and securities lending revenue came in at $4.5 billion. That's up 15% year over year.
Driven by what exactly? Market beta?
Yeah, market beta helped, but also that solid organic growth we just mentioned, plus contributions from the GIP acquisition and higher tech services revenue.
Interestingly, though, performance fees were actually down quite a bit to $94 million. What's the story there?
Well, that reflects lower contributions from some of their, let's say, more active strategies. Private markets, liquid alts, long-only products.
So when those specific funds don't outperform as much, the performance fees drop.
Precisely. And that can put a little pressure on the operating margin, which we did see this quarter.
But on the flip side, the technology side looks incredibly strong.
Oh, definitely. Tech services and subscription revenue up 26% year over year. Huge jump.
Shows the demand for Aladdin is still really high, plus the impact of buying Preqin.
Absolutely. And their annual contract value, ACV, that grew 32% overall, even organically. XFX, it was up 16%. That's robust.
Okay, let's talk expenses then. They were up too, right?
Yes, total expenses rose 14% year over year. You can see the impact of those acquisitions.
GIP and Preqin mostly.
Primarily. Compensation was up 12% from bringing those teams on board, and G&A expenses climbed 16%, also from acquisitions and more tech spending.
So how did that affect the margin?
The adjusted operating margin landed at 43.3%. Now that's down slightly, about 80 basis points year over year.
Mostly because of those lower performance fees we discussed.
That's the main driver, yeah. But management's sticking to their long-term cycle target of 45% or higher. They're focused on aligning controllable costs with that organic growth.
Makes sense. And what about capital management? They bought back $375 million in shares.
And they signaled they expect to do at least that much each quarter for the rest of 2025.
That signals pretty strong confidence, doesn't it, in their value and cash flow?
It certainly does. They're essentially saying their stock is a good buy right now. Plus, look at their dividend policy.
Targeting 40-50% of GAAP net income payout.
And historically, a 15% compound annual growth rate on the dividend per share over 20 years. That's impressive consistency. They're guiding for high single to low double-digit growth going forward, too. Very shareholder-friendly.
Okay, this all ties into their bigger strategic picture. Management's clearly pushing private markets as the next big growth engine.
Definitely. The HPS Investment Partners deal, which just closed July 1st, is a huge piece of that. Adds $165 billion in client AUM.
And $118 billion of that is fee-paying, expected to add, $450 million in revenue just next quarter.
Exactly. And you saw CEO Larry Fink actually raised the full-year organic base fee growth guidance off the back of this momentum, now 6.9%.
Plus, the success of GIP's latest infrastructure fund, Close, they beat their target.
Right, raised $25.2 billion against a $25 billion target. It really validates that BlackRock GIP combination, shows the client demand is there.
And they've set this huge goal, $400 billion in gross private markets fundraising between 2025 and 2030.
It's ambitious, and they expect it to ramp up more towards the end of that period, 2028 to 2030.
What does aiming for that kind of scale in private markets really mean for BlackRock's identity, do you think?
It means they're fundamentally shifting. It's not just about public stocks and bonds anymore. They want a massive slice of private equity, private credit, infrastructure. It diversifies their income and caters to what big institutional clients increasingly want.
Higher returns, maybe less correlated to the daily market swings?
Precisely. And it sets them up for a future where public and private investing are much more blended.
They're also innovating hard in retirement. Defined contribution, DC plans.
Yeah.
That's over half their AUM, right?
Huge area for them. And they're moving into these public-private target date funds. They mentioned a win with Great Gray.
And they're launching their own Life Path fund with private allocations in 2026. This could really change things for the average saver, couldn't it?
It really could, especially if they succeed in their talks with policymakers about litigation reform, getting broader private market access into standard DC plans.
That could significantly boost long-term returns for millions of people.
That's the argument. They quoted a potential 18% increase to a retirement nest egg over 30 years from just a 50 basis point uplift. It's a powerful idea. Plus, they just won that big $30 billion outsourcing mandate in the Netherlands. Shows their strength there.
Globally, they're pushing too. India, for example.
Yeah, the Geo BlackRock joint venture launched its first funds, raised over $2 billion from 67,000 customers already. Shows their strategy for tapping into developing capital markets.
Middle East efforts, too, around mortgage-backed securities. It's a global play.
Definitely. And you can't forget iShares, their ETF arm. Still a juggernaut.
Record first half flows reported. Big numbers in bond ETFs, digital assets, and even active ETFs.
Bond ETFs pulled in $44 billion, digital assets $14 billion, active ETFs $11 billion. Just shows the breadth.
Which brings us to iBIT, their Bitcoin ETF. It's just exploded, hasn't it? Over $80 billion in AUM recently.
It's been phenomenal, but the really interesting part, I think, is how BlackRock sees it.
As more than just a product.
Exactly. As an on-ramp for new clients, they said nearly a third of iBIT investors have gone on to buy other iShares products.
So it's working as a gateway into their wider ecosystem.
Seems like it. Kind of like their cash management platform, which has nearly $1 trillion and often serves as an entry point too. Their tokenized money market fund hit $3 billion as well.
And the Circle relationship is fascinating, managing over $50 billion of their stablecoin reserves.
And they booked significant gains this quarter related to Circle's IPO. Plus, it plugs them right into the conversation with central banks about stablecoins, about tokenization. They're right at the forefront.
Okay, shifting gears slightly. M&A, they bought Elm Tree Funds. How does that fit in?
That was framed as a smaller, tactical tuck-in deal, focused on triple net lease real estate, good for insurance and wealth clients.
But the main message on M&A was integration focus.
Yeah, basically saying, we've made our big moves with GIP, HPS, Preqin. Now we need to digest them, make them work together seamlessly, find those synergies. Large-scale deals are kind of on pause for now.
So management sounds pretty confident heading into the second half.
Very much so. They talked about a strong pipeline, momentum building, and these big acquisitions really starting to gel into a unified firm, driving that next growth phase. They feel they've got the key pieces.
Okay, so a lot of strategic ambition, some really impressive numbers, especially on the bottom line in AUM. But the market reaction wasn't exactly cheering, was it?
No, it wasn't straightforward at all. Despite that big EPS beat, the initial reaction was definitely cautious.
Investors liked the profit beat, but that $52 billion outflow, that spooked them.
It really did. It raised questions about, how sticky are these huge institutional mandates? Could there be more large outflows coming? It just cast a bit of a risk-off shadow over the whole report.
And the stock reflected that, down 5% on heavy volume the next day.
Yeah, triple the average volume. The raised guidance on base fee growth helped a bit, softened the blow maybe, but valuation concerns kept buyers cautious.
And it wasn't just BlackRock feeling the pressure. Other big financials like JP Morgan, Wells Fargo, they traded lower too.
Right, there was a broader cautious feel across the sector. Even though bank earnings were generally okay, it wasn't just a BlackRock specific thing.
And we need to remember the context here. BlackRock stock had a huge run-up.
Absolutely. Up 28% over the prior year, hit a 52-week high literally the day before earnings.
Driven by ETF optimism, the HPS deal excitement, that June tech rally.
And hopes for Fed rate cuts. All that optimism built up.
Creating what Wall Street calls a crowded long trade. Lots of people betting the same way.
Exactly. And when a trade gets that crowded, it doesn't take much negative news or even just slightly less positive news than expected, like that outflow to trigger selling, makes the stock much more vulnerable to a pullback.
Okay, before we wrap this up, let's pivot to our not financial advice segment. Time for an outrageous but plausible trade idea based on all this.
Absolutely. And let's stress that again. Purely conceptual, illustrative, not investment advice. Trading involves significant risk.
Couldn't agree more. So here's the idea. Think asset manager of the future versus the old guard.
Okay, I like where this is going.
The trade would be go long BlackRock, betting on its stock price rising, and pair that with a short position in a traditional active mutual fund manager.
Specifically, one that hasn't really made those big strategic shifts we've been talking about.
Exactly. One that hasn't significantly pushed into private markets, or scaled up its tech platform like Aladdin, or embraced digital assets.
Right. The rationale is pretty clear from our discussion, isn't it? BlackRock is aggressively transforming.
Integrating HPS and GIP for private markets, scaling tech with Aladdin and Preqin, leading the charge in digital with iBIT and the Circle Connection.
They're positioning themselves as that forward-looking player, while many legacy firms, well, they're still very dependent on those traditional mutual fund flows.
Which are arguably more vulnerable to disruption, lower fees, shifts to passive, etc.
So this trade is essentially a bet on that divergence accelerating. A bet that the innovators like BlackRock will increasingly pull away from the firms maybe stuck in older models. It plays on BlackRock's own language, their ethos of change and history of reinvention.
Capitalizing on that difference. But again, and we have to keep saying it,
Highly illustrative. Paired trades carry their own complex risks, potential for volatility on both sides. Definitely not advice.
Okay, so let's quickly recap BlackRock's Q2. Strong bottom line beat, record AUM hitting $12.5 trillion.
Driven by those big strategic moves into private markets, technology, and digital assets.
But the market reaction was mixed. Positive on the EPS, but worried about that big single client outflow and just broader caution in the financial sector.
Yet, management seems really convicted about their long-term path, especially integrating those key acquisitions and expanding globally.
And one last time, folks, remember our discussion today, especially that trade idea, is absolutely not financial advice. Always do your own research.
Consider your own circumstances before making any investment decisions.
So here's a final thought for you to chew on. As BlackRock keeps blurring the lines between public and private markets and really leans into digital assets, what does that mean for your own portfolio strategy? How are you thinking about positioning for these major shifts in the asset management world?